Here we are. I'm joined today by Denise Wong, or with Denise Wong, of Mirai Consulting, and Denise is a CPA. Denise, for the uninitiated into the world of numbers and accounting, what does CPA actually mean? What's the designation?
Sure. Hi, Shelly, and hi, listeners.
Hi.
And thank you for having me on.
Oh, you're very welcome.
And as a fellow Pursuit 365 author, I think it's very cool that we get to chat outside of writing and in our streams of genius. To answer your question, CPA stands for Chartered Professional Accountant. It just
So
means that
you're like a numbers wizard.
I'm a bean counter. I count beans. I live in the matrix. I don't see anything other than streams of conscious numbers running through my brain.
Sort of like in the Matrix, it's just like going zzz all the time.
Yeah, exactly.
That's awesome. Well, my brain does not work like that, which is why I'm glad that you and I've connected, because we're sorting out some bad financial habits that I've had in the past, and we're getting beyond that. But today we're going to talk about some experiences we've had with clients throughout their journey of either, today mostly disposing of real estate, either being in a family where they've been made the executor, or in some cases, in a power of attorney situation where you have to sell the property in order to pay for the next level of care that the person might be going to. So this is certainly an area of expertise for me in dealing with estate sales and power of attorneys. It's a kind of transaction that I actually really enjoy helping a family through. But what are some of the things that you find that could have been maybe planned better by the family, or maybe like a big aha, oops, or kind of thing that people don't often find out until they actually go to sell the property?
I love this question, but it's also a very heavy and loaded question.
Yes, well,
So,
'cause
as
every family's different, and I guess in the way they've set up their finances, or not, is the
yeah,
case may be.
absolutely. And as we started, our conversation saying that I'm the numbers person living in a stream of conscious numbers, a lot of the conversation actually doesn't start with numbers. It is around, having the right people in the family all on the same page, and actually really getting into the deep and nuts and bolts of, what does the family want to do? And um, as much as numbers are very hard, there's a very huge emotional tie when it comes to planning, planning for disposing of real estate that's been in the family for decades, or there's emotional ties to why a specific property was bought or sold. So it's a big question, and I think we can unpeel and the onion one layer at a time, and maybe we can avoid some of the tears that might actually happen when we actually do peel back those layers of the onion.
Well, one of the things that I think a lot of families and clients don't actually understand is the process is very different if the homeowners on title are still alive, and under maybe a power of attorney situation, or maybe not even a power of attorney. Maybe the homeowner is still very compos mentis and proactively wants to manage their downsize or manage their next move on their own, as opposed to the estate situation where the family or the person who's the homeowner has perhaps moved on, and an executor, hopefully there's been a will, and that person's left to deal with the rest of their family in the disposition of the real estate. I recently had a situation, probably about 2 years ago, where there was no will. And it ended up being okay because all of the siblings, I guess, mostly in most part agreed to deal with things the way they dealt with things. But what, I know a notary or a lawyer draws up a will, but what are some of the considerations they should be asking from their accountant when they're about to draw up a will, or when they are going to make arrangements for
Yeah,
the
it's a good
carrying
question.
on of that asset? Because it's really, if we're going to talk in accounting terms, it's really an asset, right? It's an
Yeah,
asset of the family.
that's right. Yeah. So it's interesting because, again, when we think about power of attorney, a lot of those are typically done by the lawyer, and a lot of the times, we come in, like, we being accountants come in sort of after the fact, when the transaction has happened, or let's say a disposition has happened, or maybe there's been a death, for example. Okay, so I typically like to work with another lawyer as well, and consult together on a team where we can actually give clients advice at the same time. Okay, and so lots of different things that need to happen. When I think about, real estate and homes, a lot of the times people think about taxes. And the first thing that we have to think about is your primary residence. Is your primary residence taxable? So in Canada, as of today, as of 2024, we don't have to pay taxes on the sale of a primary residence, but we have to disclose it on the tax return. Okay. Now,
So that's getting confusing, because with the election coming up and with some statements that have been made by certain politicians, that's kind of, people are questioning if that's still valid. But at this very moment, on May 21st, the taping day of this show, that's still valid.
correct. That's right. And as much as you don't have to pay taxes on your primary residence, when you sell it, you still need to disclose it. So your tax accountant at year end is going to ask you, so let's say you sell your property today, or there's a deemed disposition, and we can talk about what that means in a second. If CRA thinks you sold your property in 2024, when it comes to tax time in 2025, your accountant's going to ask you, Shelly, when did you buy the property? How much did you buy the property for? Did you have any selling costs to it? And there's a form that the accountant will fill out for you. And it's that disclosure of information that we're just telling CRA how long you held the property for, and how much the gain could have been. Okay. Now remember, as of today, not taxable. Okay. But need to disclose.
Right. So even though it's not taxable, it's still kept track of by our federal government, right? So that would
That is
be
correct.
part of
That
your
is
federal
correct.
taxes.
That is correct. Now, depending on who, what you believe and whatnot, I mean, this is still valuable data for the government. The government is collecting this information. They've been collecting this information since 2016. For most of our listeners that are listening, probably know that taxable capital gains, or capital gains, are subject to a 50% inclusion right now in today's world as of May 21st. But as of the 2024 federal budget, they did make some changes to that. So going forward, that 50% will be 2/3, or 66 and 2/3%
So
going
did that
forward.
get passed?
It's proposed. I believe it's supposed to be passing. And the tricky part here is a lot of people are worried about this, and maybe some people are looking to buy and sell right now, or mostly sell, because that's actually going to come into effect after June 20, I think it's 24th or 25th, I can't remember which day. It's this year. But the caveat and the trick here is it's only when the capital gain is of more than $250,000.
Okay. So if you just didn't say you bought, I don't know, take for example, somebody who bought during COVID when
Yep.
things went crazy,
Yep.
What if they're losing money?
If they're losing money, then the capital gains would not, I mean, it wouldn't be the 2/3. I mean, it could be the 2/3 times a negative or a zero is still going to be zero, right?
Right.
So that inclusion rate, if it's multiplied by a loss or a zero, is still going to be zero.
Right.
Okay. It's only if the capital gain by the individual is more than $250,000 would that inclusion move from 50% to basically 66 and 2/3.
Okay. And my understanding is currently that would only be on a property that was an investment property or not a principal residence.
That is correct as of this point.
Correct.
Yeah.
Okay.
Yeah.
One of the things that I see on a title search quite often when I'm preparing to do a market evaluation for a family is that, and quite often the adult children are quite surprised when I tell them this, is that the parents have elected to defer the property tax in British Columbia. Can you
Yes.
speak to, from an accounting point of view, how that can affect the capital gains? Is it still included as, because it's like a bill that's
Yeah.
coming due. And sometimes, I mean, if the people are in their 90s and they started deferring the property tax at 65, it could be 30 years worth of property tax.
Yes. And this is the interesting part because there's also different people telling different people what they should or shouldn't do. So this is why
Right.
it's really important to talk to your own accountant and talk to your family because yes, seniors over 55 are eligible to defer their property taxes.
Does that mean I'm a senior? It's 55. I thought
Only
it was
if you want
65.
to, only if you want to claim yourself as one.
I thought it was 65. I guess, you know what? I can go do Shoppers Drug Mart and get the seniors discount on Tuesday too.
Yes, that is
Great.
correct.
Anyway, okay, so it's 55. It's not 65.
And of course, there's other criteria as well. You know, people with disabilities, there are some other criteria. So again, check with your accountant to see whether or not that applies to you. Okay. But basically, it isn't from an accounting perspective or a tax perspective. I always laugh because it's really a cash flow problem. So you probably have heard, you know, over the last decade or so, seniors who are struggling to make the property tax payments because, you know, real estate valuations have gone through the roof and therefore the property taxes have increased over time, are struggling to make those payments. So
And certainly their pensions haven't gone up.
Correct. They're not indexed that way or the same way. And so there was a lot of discussion probably, you know, over the last probably 5 years or so to defer your property taxes. So when you defer your property taxes, it doesn't mean that you don't have to pay it. You have to pay it. You just have to pay it potentially when you sell the property. So the idea is that you're betting that the property is going to increase in value so that it's going to cover the cost of potentially paying out the number of years that you've deferred your property taxes. Now, it's kind of problematic because there's also an interest that's tied to deferring property taxes as well.
That's not free money.
It's not free at all. So it's baked into the calculation. So you defer 1 year, you defer another, then it starts accumulating. So if you can imagine over 10 years, let's say property values have increased over 10 years, therefore your property taxes that you deferred have also increased over 10 years. You know, it's not, especially in Vancouver, it's not uncommon to say after 10 years of deferring property taxes, you may, and let's just assume $5,000 of property taxes annually over 10 years with a slight increase. I mean, you could be owing anywhere up to $60, $70, $80,000, you know, 10 years down the road. And, you know, obviously with that interest rate that's baked in there as well. So the surprise that you were talking about, Shelly, is when, you know, let's say the individual has passed, or let's say they, you know, the kids have sold the house or whatnot, they are stuck with this, you know, potentially $60,000 to $80,000 bill of deferred property taxes that they might not have known had to be paid. And that comes out of the proceeds, right? That comes out of the sale.
Counting your chickens.
Yeah. That's right. So the biggest thing too, assuming there's no mortgage, then okay, what you sell are your full proceeds. But if there is a mortgage, you're going to sell. Your proceeds have to discharge the mortgage. A lot of people forget that you have to actually pay down the mortgage first. So what's left over is your cash flow. Then that leftover cash is what's used to pay those deferred taxes or deferred
Right.
property taxes.
Right.
Okay? Yeah.
So, is there a way that you can find out on a government website what the annualized interest rate is for the deferment, or how is it something that it's like an accountant's little backdoor secret thing that you have to go looking
Uh,
for?
no, it's actually very good. I believe, and don't quote, I
Because
think
I
you
know
can
the
just
one
mention to Google.
for damage deposits for rentals is on the RTA, the Residential Tenancy Branch website, the
Yes.
RTB site, but
I was
probably
going to say, if you just type into Google deferring property taxes BC,
yeah,
the
it'll come.
province of BC's website should come up, and it will tell you all the benefits of doing so. And I believe it also has the interest rate on there as well.
Right. Now, this is a question that may or may not be something that you have had to consult with people about, but I get sometimes asked about reverse mortgages, and you see the companies on TV that make your house work for you or whatever. I don't think it's a great idea because look at the trouble the economy's in with people, using their houses as bank machines. Um, the reverse mortgage, it's basically goes on the title as a bank charge, as a loan, even though they say you don't have to make any payments. Um, are you aware of these reverse mortgages? Are there any tax advantages to people having a reverse mortgage?
Yeah, it's interesting. And this is probably your expertise here, Shelly, a little bit more, right? But I think if we hear them in the mainstream media, you hear them as the chip mortgage. Is that right?
Yeah.
And
Canadian Home Income Plan, which basically to me seems like people robbing elderly people of the equity out of their home, thinking that they're going to still have equity. Like, how can you? I think you have to have your house completely paid off before you even apply for it. So there is equity to take, but I don't see really any benefit of it when I talk to people about it, because it seems like then you just have you're draining down the equity that might be in the home.
okay. I mean, I love this conversation because maybe I can offer a different perspective. Um, I think in Canada, anyways, reverse mortgages are somewhat secured by a financial institution. So I know in the 80s and the 90s there was a little bit of a negative feel that
Mm-hmm.
they were, a bit scammy. Like I think you even said it too. You're taking, seniors out of their homes and then they would lose their homes, for example, right? But I think it's become a little bit more commonplace. I think as seniors have been aging and it's become a lot more expensive to live, and these pensions, as you mentioned before, haven't necessarily increased with the rate of inflation, most of a senior's assets or values are going to be in their home. So
Right.
sometimes looking at the value of your home might not be a bad idea to think about. And I'm going to use the word cash flow, right? So
Right.
again, it's a way of thinking about, okay, well, how do I pull cash out of some of the assets that I have? Okay, you're absolutely correct. You need some equity in the home. So I believe it's usually a 50 to 55% that they'll give you back in your home. I do think it offers an opportunity for seniors to think about um, having a way to tap into their home and and you'll hear it on the ads, make your home work for you,
Work
right?
for you.
You'll hear
Yeah.
that.
And
Yeah.
I've had people ask me about it in the context of the aging in place. They need to, get some kind of loan to put a chairlift in or make
Yes.
some changes to their home so they don't necessarily have to move out of their home,
Yeah.
and age in place.
Yeah.
And certainly most people, unless they've become quite infirm, don't want to leave their house. Nobody
Absolutely.
really wants to leave their house until they absolutely have to. Um, are the generations before us and the generations before them tended to not move around so much.
Hmm.
I mean, I know I know there's friends of my parents, and they've been in the same house for 30 or 40 years. I mean, my transient lifestyle, I'm lucky if I've been in a place. I think the longest I've ever lived in one place was 8 years. But, for people that are in homes, when you look at the appreciation of the last 20 years, 20 years ago, you could have bought a house in Kitsilano for 550,000. And that would have been a really, really nice house in Kitsilano. That
Yeah.
same house could be $3 million right now.
Right. Right.
So that's a lot of equity.
That's right. That's right. And I think it's interesting for people to know that I know, like, just probably about a year, actually, this time last year, I was having these conversations with my parents. They had just retired. They wanted to get out of their family home. I know a lot of people want to stay in their homes, but for sometimes medical reasons, you can't get up and down the stairs. So
Mm-hmm.
living in bed, like in a condo with a couple of bedrooms without the stairs was very appealing for my parents. So we had to have kind of had that conversation around, well, how long can you possibly stay in the house? And again, same idea, generational ideas of not wanting to have mortgages, not wanting to have debt. So when we sold the family home, there was a nice gain and some proceeds there, and they used the lump to buy their condo so that they don't have to make payments and whatnot, right?
Right.
But the big question, and I kind of bring it back to the chip mortgage or the reverse mortgage, is a lot of people ask the question, well, is this going to impact my old age security or my guaranteed income
Or
supplement?
is it considered income?
Yeah.
Do you
So
have
it
to take
doesn't.
it in as income? It doesn't?
No, no, it
Yeah, 'cause
doesn't.
if it suddenly became income, then what's the point if you're going to have to pay tax on the equity that you already paid tax on the earnings to pay
Yeah.
down the mortgage to pay off the house? Just like tax, tax, tax.
I mean, I think that the trick is in the word, right? Reverse mortgage. So technically it's a loan. So
Right.
hopefully you're not paying taxes on loan proceeds, and that's how CRA sees it. CRA being Canada Revenue Agency, our tax body. So when you get a reverse mortgage, you're basically securing the loan with your home or the value in your home. Okay,
Yeah.
for the most part, the risk, is the biggest risk would be if the value of your home went down significantly.
Right.
Right? But I mean, again, hindsight's 2020. In the last 20 years, it hasn't been a problem for us here in BC. But again, that's kind of why that has been a great environment for people to do these reverse mortgages.
Right. Right.
Yeah.
Well, it's one of those situations where I think it's probably requires a whole 360 on all of their planning,
Yep. Absolutely.
because there's also, what are some other surprises that an executor or a POA can run into when they go to either have the conversation or they find themselves. I know I had one client where their parent had a stroke,
Hmm.
and the spouse had already predeceased the remaining person. The remaining spouse had kept meaning to update the will, but never did for like 6 years after their spouse had passed. They had a stroke and they hadn't updated the will to have anybody else in the family to be the executor. And because they'd had a stroke, there was no POA paperwork in place. So I know this is sort of lawyer things, but from an accounting point of view, it's not a question I can answer, but if an adult child finds themselves in the situation of suddenly having to manage the affairs of a parent that become incompetent for the sake of managing their affairs. We don't mean they're incompetent. That's just the legal term for somebody who's not able to manage their affairs anymore. They're not compos mentis, or they've had some kind of brain injury or something where they just can't deal it. How, like, what steps do they have to go through before they have the ability to even talk to an accountant and have things moved over to them if there's no POA in place?
Oh, this is a very tough question.
I know. I've been trying to figure it out too, and it's like, I just really encourage even my young buyers and their first time buyers. You're buying a property. You never like to think about the worst case scenario, but I even encourage my young buyers to get their wills and get some things in place in case anything was to happen to either one of them or to them themselves, even if they're single.
Yeah. I mean, I have this framework called the ABCs: awareness, baseline, and clarity. So, if anybody finds themselves in that unfortunate situation, without the updated documentation, the first one is awareness. We have to go and figure out, okay, what exactly are we talking about? How much stuff are we talking about? What assets, what liabilities, and who are the people? So again, definitely for sure, try to take an inventory, and typically I would say like a balance sheet. I like to think big companies do it well. Big public companies do it well. So they have a balance sheet. Take that same idea, that same approach, and apply it to you personally. So what would be on your balance sheet, or your parents' balance sheet, or whoever individual that you're being the executive for? What kind of things would be on that balance sheet? What assets? When we're talking about assets, you're talking about bank accounts, we're talking about investments, we're talking about assets, property, the cottage, even the car. Like, what are we actually talking about? And then from each of those pieces of assets, the next question would be, are they free and clear? Do they have any liabilities associated with it? So if they are free and clear, okay, we know we're dealing with assets. If they're not and they have a liability, like let's say there's a car and there's a car loan.
Credit card debt or something like that.
Absolutely, right? So just knowing what those are, and sometimes those credit card debt, that's kind of easy. You might get a statement in the mail and all of a sudden you're like, oh, yep, we've got a credit card. But there might be some things that are not spoken or you might not know about. So there could be like a promissory note that was written. So if the person that you're the executive for is a business owner, for example, and they had certain arrangements with other people, you might not know that until some of those lenders or creditors come out of the woodwork looking for their money. So sometimes executors do get that surprise, haha, by the way, I'm here for my pay or my payment or whatnot. So again, just awareness, taking an inventory, figuring out what's on the asset side, what's on the liability side, and then trying to find out how to get access to things. Now, it's one of the tips and tricks that I do is I have a password keeper, okay? And actually, as part of my will, I actually have my access to my password keeper as part of as an appendix to that. Okay. Mm-hmm. Now, the one thing I need to remember is when I change my password to update that. Okay.
But I've been locked out of my account for the 29th time this year. I got to change it again.
So one of the things that I do, and I'm paranoid. So whenever I travel, I actually have an in case of emergency envelope, and I always make sure that my password to my password keeper is actually in there, and I give half to my spouse and half to my brother, and they only open it if anything happens. And that's me being paranoid. But again, maybe each their own. It kind of works for me. It gives me comfort. I know I have my will. My will's, was done a few years ago. And I would recommend reviewing it. One thing I learned when I was doing my will was there's a reason why the lawyers actually clip the corner. Do you know why they do that, Shelly?
So it can't be, it's actually the one.
Yeah, it's the original. So you can't make copies and duplicates because you see all those movies where, people are contesting bills and yeah, and they weren't of sound mind when they made this one on this date. So anyways, so I would then recommend reviewing your will when you have big major life changes, whether that be having children, buying more property. Although your lawyer should be able to write the will in such a way that even if you were to buy another property or two, that could be included, and it all depends on how you want that written into your existing will as well. Okay. So again, the checklist would be figure out what you're working with, figuring out who can get you access to it, and then working with what you have in the existing POA or the existing will and moving through it.
How do you find making people comfortable about talking about money? Because this is one, we could spend a couple of episodes just delving into this topic, but I think you and I could both agree that it's so important for families to be able to talk about money and it to not be weird. And I know there's in different cultures, there's also, some beliefs around speaking of death or planning for death. And it just, it just so often happens that we as professionals enter into a situation with the family where if only people had had some conversations, it would have made things a lot easier. Like I asked my dad every time he goes on a trip, because he's still working crazily enough, which sends him all over the world. But hey, Dad, remind me, where do you keep your will?
Mm-hmm.
And I know where it is, but sometimes he moves stuff around. Hey, Dad, who's your lawyer? Right. Just knowing some basic things about, your parents or the people that you might end up having to be responsible for. And he knows when I'm asking him that I'm not expecting him to just suddenly crash in an airplane or something. But, it's important to be able to have conversations in families about these things. And some families just don't talk about it.
Yeah, I love that. I just come back from San Diego from a financial therapy conference.
It sounds oxymoronic. How can financial and therapy be in the same sentence?
Well, it could actually be therapeutic, right? Okay. In my firm, I would like to think, we are a little bit different in that we're a bit heart-centered. We're not just all about the hard numbers. We actually do have our past, present, future framework. We help our clients honor the past to embrace the present so they can shape the future. And all of that's super relevant for everything we're talking about, because money and how we get comfortable talking to money means that we really have to honor our past. We have to really think about what are some of those money truths that our parents, even our grandparents, might have subconsciously taught us just by being around us every day. And then embrace it, and understanding how those shape you today, right? How embrace what that means to you today so that you can actually shape what it means for you tomorrow. So again, that conference was very helpful because the focus and the theme was around culture and societal norms. In my culture, it's always taboo to talk about money and death. And if you even wanted to talk about it, that would be a symbol of no, you can't talk about it because you're going to bring some negativity into it,
Right.
and maybe this might be manifest destiny, and somebody is going to pass away because we talked about financial planning for, for your elder care, for example. Okay.
Right.
And I know that, that used to be my grandparents, and we never talked about it. It was super taboo. But also as an accountant, I have the privilege of being able to have that conversation with my parents. But I'm going to tell you, I've been an accountant for over 20 years. And the first 5 to 8 years was like pulling teeth with my parents. They didn't want to talk about it.
Well,
They thought they knew more. And it's only recently, obviously with, more complex tax changes, I do take care of everything for my parents in terms of the tax world, helping them fill out forms, the complicated. It's really getting, as the sandwich generation, right? You probably have kids,
yeah.
you have your parents, you're going to have to really figure out which of the tax rules are going to be applicable to you and your family. And the big ones, I know we talked about the reverse mortgage, and I think actually, Shelly, you even talked about sometimes seniors will actually go to the reverse mortgage because they want to make a renovation. But there's actually a tax renovation credit available to seniors up to $10,000 for the property to do the walk-in bathtub, for example,
Right.
or
Right.
to put that lift chair in, for example. Okay. Now it's $10,000 per house or per property. So you can't have two spouses try to claim it together.
Right.
But again, this is the government trying to keep seniors in their homes for longer. Okay.
Well,
But again,
sorry, I'd expect there's also some things for upgrading. I know in general, you don't have to be a senior. You can get upgrades for energy efficiency items.
yeah,
Better furnaces, on-demand hot water, heat pumps, things like that. So,
that's right. And I believe those are not just for seniors as well. There's the green
mhm,
initiative that actually that's more of a provincial, and sometimes there's a federal part as well, but that's mostly provincial. But what I'm trying to get at is, as as the daughter of seniors that are aging, they're going to hear things. Okay, they're going to hear their neighbors talk about it. They're going to hear, other people talk about it. So once they have a little bit, and they hear it on the news, once they have a little bit of interest, spending a little bit of time explaining it to them, trying to do a little bit of research and figuring out, hey, there's some benefit here for you. Would you like to try it? As opposed to saying, hey, you should do it. Actually, I found has been really helpful, because it's like almost whetting their appetite, giving them a little bit of a carrot. And
right.
again, they start to be like, hey, well, my friend said this. Do you think we can get that? So, the most recent one that I've been asked about was, oh, what's this Canadian dental benefit thing for seniors? So again, it's, having them be able to hear the bits and pieces of news. So they need to be, a bit connected, and, have those conversations with different people, or hear it through the news, for example. And then having them kind of bring it up and be interested in talking to them about it was going to get them a little bit more. Once you've encapsulated them in that, you're like, oh, and by the way, did you know there is this other thing as well? That gets the ball rolling. So to kind of break down the barrier of having that talk becomes a little bit more commonplace, and it's not so stigma. It's not so difficult anymore. I'm not manifest destiny. It can actually be a pleasant conversation, and then you have, two adults having conversations, and your relationship gets a bit better too.
Well, and having the doubt and the worry around, well, I don't know what I've had clients say to me, I have no idea what my parents want, or I have no idea how I deal with this situation if my
Yeah.
spouse suddenly passed away. Because, when you're in your 50s, you sometimes, unfortunately, start to lose friends, not just elders. So it is important, I think, no matter the stage of life, for people to have their financial situation reviewed and in order, from everything from a tax point of view and planning to um, retirement and into the future. I
Absolutely.
like I like the way that you what did you call your system where you're looking past, present, future? What do you
Yeah,
call
our past, present, future. So we basically help our clients honor the past because the past has happened. It's happened. We need to, we need to work through that and really feel it. And then what we're going to do when you've honored your past, you can embrace where you are today. So you can embrace, and I like to think about it from a accounting tax perspective, bookkeeping, recording the past, how much you paid for something. That's embracing the past. You bought this property for this amount. I can't change that. But what does that mean for me today? Well, maybe I have a gain today, maybe I have a loss today. So I have to embrace what that means for me today. And then it's going to shape what I'm going to do tomorrow. It's going to shape my decision for tomorrow. So let's say I do have a pretty big gain today. I might want to decide to sell because I want to trigger a gain, because maybe it's more than the $250,000 that's gonna impact the capital gains inclusion after June 25th this year. So I might make that decision today. Okay. But if I
right?
have a loss, maybe it doesn't. So again, honor, embrace, and shape. So again, you have to kind of honor where you've come from, where you are today, so that you can shape where you want to go tomorrow.
I love that. Well, I think that's a good ending. I know that I'm going to have you on a few more times over the next while because it's such a huge topic. But I'm really glad that you could join me today, Denise. And if people want to get a hold of you, what's the best way? We'll have some hashtags and some contacts in the below. But what would be the best way for people to get a hold of you?
Absolutely. You can reach us on our website, which is www.miraiconsulting.ca. You can reach out there and book some time with me or anyone on my staff.
That's awesome. Well, and congratulations on building your business over the last few years. I know it's been a labor of love, and look forward to seeing you in your new office in a little while.
Thanks, Shelly. Hopefully we'll get there this summer.
Awesome. Okay. Take care, Denise.
Thank you.